Counting 10 wholly owned subsidiaries. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email and phone number, and the source of this information is the advanced accounting text for McGraw-Hill. We have talked about differentials in the prior video, and not only can we buy a company in exchange for common stock, we can also buy it in exchange for and get the proceeds by issuing debt. So to go back to our definition, the differential occurs when the fair value of the assets we're buying is more than the book value. And just like equity, common stock has a market value that can change, debt offerings also have market values that can change. Depending on the bond's interest rate, the price can be higher or lower. We covered that in prior videos in intermediate accounting. So since the market values change, the fair market values change as well. And finally, we have the same entry when we consolidate the parent and the subsidiary. We eliminate the equity accounts for the subsidiary by debiting, that is, common stock and retained earnings balances, and we credit to eliminate in consolidation the investment account. If I flip over to Excel, what I've done is set up Hollywood Jeans balance sheet, book value, fair value, and there are differences between the two, between fair value and book value. Specifically, the inventory is $10,000 higher as fair value when measured by fair value. The land's $15,000 higher, fair value. And the building and equipment's fair value is actually less than book value. Continuing down the page, you'll see that the debt, the fair value of the debt is less than book value, so that actually helps. That actually is a benefit from a fair value standpoint, because from a fair value standpoint, our debt, our bond payable, is lower. And if I add up the impact of all those differences, which is this summation, I end up with a fair value greater than book value of $26,000. So let's keep in mind what's going on. Levi Jeans is buying Hollywood Jeans, and we found that Hollywood Jeans' fair value is greater than book value by $26,000. Let's further assume that Levi's is going to buy 100% of the book value, and instead of paying all cash, Levi's is going to also issue debt, to raise the funds to make the purchase. So that's what's described in my transaction here. Levi's purchases all of Hollywood Jeans common stock for $270,000. What's the source of the money for Levi's? Some of it's cash they already have, and some of it was because they issued an 8% bond for $100,000. So the entry on Levi Jeans' books is an investment account, Hollywood Jeans, $270,000, crediting reducing cash $170,000 and issuing a bond payable for $100,000. And this is going to be posted to Levi's balance sheet on the consolidation schedule we'll see in a minute. The differential again was explained in Advanced Accounting 7, but let's go through it. We look at the fair value of the consideration, the cash that was paid and the bond that was issued, that's $270,000. If I look at the book value of the assets acquired, the common stock and retained earnings adds up to $225,000. If I flip back to Hollywood Jeans' balance sheet, we see that the common stock and the retained earnings has a book value of $225,000. And we have a difference, which is our differential of $45,000. In the prior video, and I've mentioned it's small here in blue, we have the reasons for the differential existing in the first place. There's one of two reasons. The first is the fair value of the some specific assets is greater than book value. That's one reason. Or there is some goodwill that exists that hasn't been recorded yet. So if we take a little further, as we did in the prior video, let's look at the detail of the differential account. Here's the fair value of the consideration, $270,000. Here's the fair value of the net assets, assets minus liabilities for Hollywood. And if I flip back to my balance sheet comparison for Hollywood Jeans, fair value, and I look at assets minus liabilities from a fair value standpoint, this number, I see that the fair value of the net assets is $251,000. That's where I got the number over here. However, the book value of the assets that we bought for Hollywood Jeans, the book value is only $225,000. That's reflected back over here. Book value of the assets, $821. Book value of the liabilities, $596. So our differential is made up of two things. The difference between book value and fair value, which is a total of $26,000. That we came up with over here. And the rest of it is consideration paid over fair value, which gets us from $251 to $270. That's $19,000. So now we want to consolidate the balance sheet for Levi's and Hollywood, and we need to make some elimination entries to get to a consolidated balance sheet. We're going to make two entries. The first is we're going to eliminate the investment balance. So we're going to credit the investment balance. We are going to debit the common stock and retained earnings of the acquired company Hollywood. And in order to make the entry balance, we need a $45,000 debit. That's our differential. So this entry is to eliminate the investment balance. And since these numbers are in blue, you'll see up here in the eliminations, debits and credits, numbers in blue. Right here. Investment, differential, common stock, retained earnings, debits. But we need to get rid of this differential balance. It's a debit. So we're going to credit it to get rid of it. And all the other entries relate to those differences between book value and fair value. If you go back here, we notice that inventory was $10,000 higher at the fair value. So we're going to increase the value of inventory to reflect the fair value. Land, its fair value was $15,000 higher. We're going to debit land to reflect the higher fair value. Building and equipment, its fair value was $20,000 lower. We're going to credit building and equipment. The fair value of the debt was lower by $21,000. We're going to debit. And those are all the accounts, the specific accounts where the fair values were different than the book value, but we're left with $19,000 as part of our difference. We found out over here that the consideration paid over fair value is $19,000, and we're going to post that as a debit as goodwill. In order to make this whole entry balance, we have a debt credit of $45,000, which gets rid of our differential balance and takes it to zero. So if I look at my entries in brown, inventory, higher fair value, land, higher fair value, recognizing goodwill, building, lower fair value, and then the net bond payable, lower fair value, which actually works in our favor by debiting, and then we get rid of the differential. Finally, you will see that our assets and liabilities balance so that the sum of all these elimination entries here balance. That's not on the sheet, but I checked it, and we have assets equals total liabilities here on the far right on a consolidated basis. That's the end of Advanced Accounting 10. You'll find hour-long sessions that are available on GoToMeeting, our YouTube channel, Ken Boyd STL. For individual tutoring, both one-on-one and in small group, you can go to our website. Here's our email and our phone number. Thanks very much, and we'll see you next time.